Clearly, there is nothing new about the problems posed by uncertainty and complexity. Our hypothesized world is simply one where there is much more of it, hence the need to respond in a different kind of way. Aristotle is once supposed to have asked Alexander the Great what he would do in a given situation. Alexander replied, "I cannot tell until the circumstances arise." For this reason, Alexander is often considered to be one of the founders of contingency strategy. Why is this important for investors today? What contingency strategy effectively means is preparing for shocks by obtaining a state of portfolio or trading readiness. What this means is envisaging several or many possible futures and using intellectual resources to envisage the specific circumstances of each, as well as ways to maximize investment returns in each set of future circumstances. For investors, the goal is simple, namely to find a way of introducing flexibility into investment by scenario development, thereby covering the possibility of multiple equilibria. Investment Strategy Wire sees the need for a three-stage process in preparing contingency strategy for investor clients. First, assessing the range of possible future risks. Second, coming to views regarding the alternative dynamics of the core features of the world economy, as it is the dynamics of the core, i.e. the economies of the US, China and the Eurozone, that invariably trigger specific risk factors and the paths to specific macro scenarios. And third, building a series of macro scenarios with associated asset allocations for each. Risk assessment. In risk assessment, we are attempting to do a better job of dealing with the known unknowns. In the past, uncertainty levels were normally lower, and therefore prime risk factors were not always considered within the main investment scenario and were effectively ignored. Such risks were somehow outside issues and were not well integrated into investment strategy. Investment Strategy Wire believes that potential and actual shocks are now so numerous and likely that they now dominate the investment scene. The response to this diagnosis is that investment strategy needs to do a much better job of integrating market expectations and the known unknowns. In other words, only unknown unknowns should remain as legitimate surprises for investors. It is no secret that the investment world is inundated with different types of risk. Indeed, pretty much anything that can alter future asset returns is effectively a risk factor. How is it possible to deal with such a multitude of risk factors? First, risk can be prioritized. Here we suggest the following prioritization criteria: risk importance, risk likelihood, and risk sequencing. The use of these criteria should allow a base scenario to be built with 2 to 3 other primary alternative scenarios. Second, in a more uncertain world, there is a need for breadth as well as focus. Therefore, additional thumbnail scenarios should be built for the less likely risks. In this way, the risk space is covered by a T-shaped strategy using a combination of focus and breadth. A further simplification is to think of the dynamics of the global financial market as being primarily driven by the economies of the US, China and the Eurozone, with oil becoming a fourth factor from time to time. Because of this, there is a kind of primate distribution to global financial risk, with by far the most important risks coming from relatively few issues. Because of this, we refer to these 4 factors as the global financial market core. Overwhelmingly, what happens in the core determines the configuration of global asset markets and, in turn, differential asset class performance, both globally and by world region. In a sense, any shock or risk factor that compromises the financial functioning of part of the core, whether it originates inside the core, e.g. the Lehman event, or outside the core, e.g. potential Hungarian insolvency risk, can be interpreted as systemic risk. Because of the way markets actually work, we are in a sense living in a 2 to the power 4 type of world, with possible positive or negative macro shocks from the US, China, the Eurozone and oil dominating markets. Although the existence of the core may simplify the maze of financial risks that investors confront, it still leaves us with the difficulty of developing a 16-scenario mindset. This may be a tall order, as many investors still think with a single scenario hat on their heads, particularly as many investment traditions come from an age where world financial markets were dominated by positive or negative shocks from a single source, namely the US. Does this mean that the level of macro uncertainty is now so great that we have come to the end of predictable futures? A reasonable answer might be no one knows, but quite possibly yes. However, maybe this does not matter if we arm ourselves appropriately. There will always be a next turning point, even if it is not possible to determine where a series of turning points leads to. Our crucial point is that if we arm ourselves for an array of possible shocks, investors can benefit from them rather than be held hostage to them. Hence the central importance of the turning point. In such a world, it is the turning point that is the important feature, as this is where returns are strongest. Here it is best to predict the next shock and have trades already in place, but second best is to recognize the shock as a turning point when it happens and to get in as early as possible. Hence the need for preparation. The crucial point is that directional investors can actually benefit from greater uncertainty due to more turning points, but if and only if they predict and prepare for them appropriately. And this is particularly so, as although there may be more frequent turning points and more irregular pricing patterns, each type of shock is likely to have quite predictable outcomes in terms of relative asset class performance. So once again, uncertainty can provide opportunity rather than limitation. It is therefore the primary raison d'etre of investment strategy wire to help investors prepare for such turning points and to help them play them. The scenario method has been around a long time, and it is important to adapt it to the issue at hand. Our key objective is to predict turning points, as new market direction is the place where returns can be maximized. We aim to identify a base scenario and the other main alternatives through the importance, likelihood, and sequencing criteria, noting the primacy of sequence in terms of what will actually occur in the future. We use analytical drill downs to focus effort to best understand the timing and mechanics of potential turning points. Our goal is to construct multiple scenarios covering the range of potential multiple equilibria. To be practical, i.e. to manage the complexity of dealing with multiple scenarios, we confine scenario development to their distinctive macroeconomic essentials, plus identifying potential trigger factors and the asset class allocation implications of each. What of the future path of uncertainty? One way of trying to answer this lies in understanding the extent to which 2007 was a unique event and the extent to which it was a function of the increasing secular changes that we have pointed to. There is a strong case for both, but it is clear that much of the cause behind 2007 was surplus recycling. Indeed, credit standards and repackaging risks via CDOs and CLOs can be seen as a symptom rather than the cause of the crisis. As secular changes by definition do not disappear overnight, our hypothesized shock-orientated world of the new abnormal may prove to be a permanent feature of world economics. Could elevated uncertainty be cyclical in nature? It may well be the case that forces such as macro-prudential policy and financial repression may diminish uncertainties. It is also possible that advanced nations may be condemned to a low-growth Japan-type world on the edge of price deflation as they continue to delever. Or perhaps renewed global growth will once again disguise the risks of heightened uncertainty, in the same way as recession exposed it. Or maybe this time it really will be different, and the growth bailout will be blown off track by the end of the 30-year bull market in bonds. Once again, we do not attempt to answer questions here, but simply point to the need to prepare for an uncertain future, where even uncertainty itself may become more uncertain. In conclusion, we repeat the crucial points made in this analysis. First, even if it is not possible to determine where a series of turning points leads to, there will always be a next turning point. Second, if we arm ourselves for an array of possible shocks, investors can benefit from them rather than being held hostage to them. Third, investors can actually benefit from greater uncertainty due to more turning points, but if and only if they predict and prepare for them appropriately. We have outlined our uncertainty proposition and how it is possible to profit from this by using strategies that prepare for multiple futures. We end by returning to our three investment criteria: realistic, flexible, innovative. We have shown how these principles underscore our approach to heightened uncertainty through contingency strategy. However, we believe that the three criteria are sufficiently universal in application to sensibly support all economic change, irrespective of type or magnitude. This brings us full circle and explains the criteria we have for investment strategy-wise investment approach.